Most people have no clue that they could be saving some money if they're a solo entrepreneur and on their own. And what do I mean by saving money? I mean real money. Tax dollars. Tax dollars is your biggest expense. Why aren't you, as an entrepreneur, saving money on your biggest expense? Hey there, Kenner French from vastsolutionsgroup.com. We're here to talk about one thing and one thing only today on this podcast, and that is a reasonable salary for an S Corp. Now, a lot of people think, whoa, an S Corp, that's kind of confusing, it's technical, etc. It's worth, if you want to save money and tax dollars, it's worth you listening to this podcast if you're a solo entrepreneur kind of on your own and you want to lower your tax liability. I'm going to get straight to it. Let's go ahead. Have you formed an S Corp in order to pay fewer taxes, generally speaking? Usually people say no. People usually just, take money into their own Social Security, as a sole prop, and they are good paying taxes on April 15th. Not good. Well, let's go ahead and get some specifics. What do you do to get, when you have a low salary, what do you get? One, you save payroll taxes. Two, it allows for splitting of more income. And finally, it also can help manage your deductible losses in some circumstances. I'm going to give an example. Bill Smith, let's say he's a realtor at ABC Brokerage. He operates as a sole proprietorship, or sole prop as sometimes they're called. He pays, self-employment taxes, let's just say, around $14,000 on his $100,000 of income. If Mr. Smith operates the business as an S Corp and he pays himself a salary of, let's say, $50,000, takes $60,000 as a distribution or a draw, sometimes people call it a yield, he will save roughly in this circumstance $7,000 in taxes, specifically self-employment taxes. Now, why would you not want to save $7,000 in taxes? Now, that's only assuming, by the way, that this guy, Bill, has an income of $100,000. Most of the people listening to this podcast are probably making a little bit more than that. Usually let's just say most of our people who listen to most of our stuff or watch most of our stuff or call the office, usually they're making about $1 million, usually a little bit more on average. So think about that. Now, multiply that $7,000 by 10. You're right. That's $70,000 in self-employment income taxes. How does that sound? That's real money. Now we're talking real money. That can buy you a nice little Porsche, per se. Now let's go ahead and talk about the distributions. They do not trigger self-employment tax, as you can tell, because they're lower, right? Because there are no self-employment tax on distributions. Now, sure, there's a risk factor. If Mr. Smith's salary becomes too low, he faces, payroll tax penalties up to, frankly, 100%, as well as negligence penalties. But now, you got to think about what is too low. We're going to get into that in just a little bit, by the way. The splitting income strategy generally involves giving stock to lower tax bracket relatives so the company unit as a whole can save money. I'll give an example here. And these are just general examples. Each specific circumstance represents a very specific, unique consultation, but I'm going to speak in general. Now, John Ford, let's say, has gifted 40% of his S Corp stock to his parents and his wife's parents. Now, if the corporation, let's say it earns $200,000 and he takes a salary of $150,000, his parents and in-laws receive $20,000 in their lower tax brackets. Let's say it's $50,000 in profit times whatever, 40%. If he takes a salary of, let's say, $90,000, his parents and in-laws receive $44,000 in their tax bracket, $110,000 profit times 40%. Now, a little planning note, which is relatively important here. The ability to split S Corp income with college age and younger children, it's pretty much gone, by the way, nowadays. You can get in more specifics, but give us a call or check out our website for specific information about the tax law changes that impact that. And by the way, the website, as you probably know, www.vastsolutionsgroup.com. Managing loss deductions. The at-risk rules limit the S Corp owner's tax deductions to the amount at risk. If an owner is rubbing up against the at-risk rules, lowering the salary can reduce or eliminate the non-deductible loss. Now, the IRS does not like some elements of this. The IRS has not been really helpful. It's been a little bit late to the party as it relates to salary relative to the S Corp, having done almost nothing to address the issues, at least early on. The early neglect has created a huge problem for us as well as the IRS, and that still truly exists today. They gave a little bit of guidance and it still hasn't really helped. Now, currently the IRS is auditing about 0.04% of the S Corp returns. Now, let's just remember, your chance of getting audited is usually around 1%. So if you have an S Corp, it potentially, therefore, if you look at the numbers, can lower your chance of audit as it relates to having an S Corp. Zero salary. Now, I was just on a mastermind call, where people were asking about salaries of taking a $0 salary. The IRS has generally consistently been winning court cases against S Corps where they're paying no salaries. Now, not good. When the IRS discovered, let's say, well, actually, this is true to life specific instance. This accountant, Joseph Gray, to be exact, he advocated zero salary for himself and all of his clients. That was a landmine as far as litigation went. So, focusing on Mr. Gray, that accountant, either as a taxpayer or as an accountant specifically, the IRS won 7 cases against the S Corp consultation for paying no salary. So not only he got in trouble for doing no salary or taking no salary, but also his clients who were taking zero salary. By the way, then the question is, how long after an S Corp is set up should a salary be taken? And that's open to debate, and every situation dictates a unique consultation, as I mentioned before. What I would say, by the way, in the second of Joseph Gray's clients, Mr. Gray found himself and his S Corp in court trying to explain the zero salary conundrum. It didn't work well. In a regular opinion, by the way, the court ruled that Mr. Gray's zero salary was improper and that all distributions were to have been taxed as a specific salary. Exactly 1 year after the first case, as a matter of fact, in which he was an accountant, Mr. Gray was an accountant, tax court issued 5 memos and decisions outlining 5 additional cases in which Gray served as the accountant. So in each of those 5 cases, the court ruled that the S Corp strategy of paying zero salary to the owner was improper, et cetera, et cetera. You can call it for not only the specifics about that case or any caveats outlined here in this podcast. Please go ahead and give us a call if you have any questions at 888-808-8278, extension 701. Again, 888-808-8278, extension 701. We'll be happy to provide you all the various specific caveats, etc., as they might help you in your circumstance. Now, zero salary was a common mistake in the cases of Mr. Gray. Zero salary, I'll just tell you, bottom line, it will not work out. Don't even think about it unless you have zero revenue. That could potentially be a reason or argument for taking no salary, and we can talk about that if you call in the office. Tax law says that an officer of your S Corp, specifically, you're an employee of your S Corp for Social Security tax purposes, unless you're exempted from the rule by another section of the tax law. You're probably not going to be exempt. As an officer of the corporation, you're only exempt if you do not work for the corporation, or you neither receive nor are entitled to receive, directly or indirectly, any remuneration. By the way, I'm going to outline this. It's a little sticky, a little complex, but it's worth noting. In the Revenue Ruling 7444, 2 shareholders of an S Corp took zero salaries and claimed all the profits as distribution, not subject to unemployment taxes. Now, wrong per the IRS, classified the distributions as wages for FICA, FUTA, and federal income tax withholding. So again, taking zero salary, that's a no-no. Save taxes and pay, I should say, save taxes and headaches. Just pay yourself a salary. Rule 1 in the S Corp strategy is to save tax dollars to pay a salary. What is the proper split between the salary and the distribution? As I mentioned earlier, that's always kind of the ongoing conundrum, always the ongoing question. Is there a formula? Does the IRS provide guidance? I was just asked again in another mastermind I did earlier this morning, same question, which I understand. No, there's no proper split. There is no specific formula. The IRS provides no guidance. It really doesn't. This is one of the places where a tax practitioner has to rely on judgment. There's no scientific formula. The IRS has spent time, and truly little time, and had little success in attacking S Corp owners who do take salaries. Further, with 1 million one-owner S Corps already identified as easy targets because there are no salary policies, why would the IRS bother with taxpayers who are taking salaries, right? In a court case called Rocco, the IRS lost its bid to allocate S Corp distributions to Mr. Rocco and his salary. He created an S Corp with a total capital structure of $2,500, kept 4% for himself, and sold 96% to family members. Obviously, Mr. Rocco was looking at doing some income tax splitting. After paying his salary, the S Corp distributed big dollars to the shareholders. The IRS thought, the small capital structure, small salary, and large distributions were just too much, and took Mr. Rocco to court. The court ruled, therefore, that Mr. Rocco's salary was more than adequate because Mr. Rocco and his accountant proved to the court that an outside person could do his job for 1/3 of what he took as a salary. So, was that smart thinking? Mr. Rocco took what the court considered a reasonable salary, and he and his accountant put together the proof. Think about proof when you want to plan your salary. The IRS was, they also lost the case, the Davis case. Mr. Davis, a surgeon, organized 2 S Corps, an X-ray company and a physical therapy company. He gave 90% of the stock in the 2 corporations to his 3 minor children. The IRS tried to allocate all income of the 2 corporations to Dr. Davis and his salary. The court said, nope, absolutely not. Mr. Davis spent little time in the 2 corporations, although most of the patients came from Mr. Davis or Dr. Davis's referrals. I should note, when looking at court cases, keep in mind the IRS has lots of potential court cases to consider. The IRS does not take court cases on that it's going to lose. It doesn't make financial sense in any case. The IRS won a partial victory in this case, Mr. Rube. He made the tragic error of offering no evidence to support his low salary. When he arrived in court, he was pretty much at the mercy of the court as a result. It's bad to expect mercy from the court. Nothing usually good happens there. The IRS came up with a salary it deemed reasonable and made a presentation in court. Mr. Rube's strategy in creating his S Corp worked like this. Before incorporating, Mr. Rube, ROOB, I should note, operated his photo studio as a sole prop. When he incorporated and chose S Corp status, he split ownership equally among himself, his wife, and his 8 kids. You can see that part of his plan was to cut taxes by splitting income. The court ruled that the IRS estimate of salary was correct as an estimate based on the lack of any reliable estimate for Mr. Rube. For the last of the 3 years involved in the case, the salary change produced a 55% of the income as salary and 45% as distributions. For Mr. Rube, the 45% in distributions were saved in self-employment taxes and saved the family taxes with the income splitting benefits to the lower tax bracket of the kids. The strategy of income splitting with the children would not work today because of the kiddie tax, but generally speaking, I think it probably makes sense to understand. You got to, establish a reasonable salary. The National Taxpayer Advocate noted that it's difficult in time time-consuming for the IRS to establish a fair and reasonable salary. It just won't work. Imagine how difficult a task it would be for every instance or every circumstance to have a specific challenge in place by the IRS. So you see almost no court cases where the owner is collecting a salary from the S Corp. Further, as I mentioned earlier, the IRS has plenty of low-hanging fruit with people who are taking no salary. Don't be in that group, by the way. What's a reasonable salary? The IRS can't tell you, as I've mentioned. There are no specific guidelines for reasonable compensation in the tax code or regulations. Most court cases on the salary issue deal with a salary that's too high because the C Corp owner tries to take money out of the C Corp through a salary to avoid the double taxation element. Now, there's a bigger issue there, by the way. Anyway, the double taxation is not a problem for the S Corp. You don't have that issue. In determining the proper salary, the IRS notes a few things: training and experience, duties and responsibilities, time and effort devoted to the business, dividend history, payments to non-shareholder employees, timing and manner of paying bonuses to key people, payment by comparable business for the quite similar situations and services, compensation agreements, etc. As you can tell, there's a lot involved, but generally speaking, just take a salary. Do your consultation with a business consultant as an example. Now, if you need any help, this is a thorny issue, but it's an issue that can save money. It can save you tax dollars so much. Well, give us a call if you need anything. 888-808-8278, extension 701 is the phone number for vastsolutionsgroup.com, or just go to the website again, www.vastsolutionsgroup.com, or keep listening to podcasts like this, where there's a lot of good added value information that's coming out of this podcast. And it is a pleasure that we've been able to take this time with you, and hopefully it's been truly value oriented, so you've seen value. That's just one of the little nuggets we have out there, is providing value to entrepreneurs who are struggling because there's a rough amount of seas out there, but we're here to help. Once again, this is Kenner French. It's indeed been a pleasure spending time helping you navigate the rough waters as an entrepreneur.